For zero DTE, the July performance and year to date is 8,958, and we had a $893 profit, and this includes commissions and fees. All right. 7 DTE year to date is 2154 for July, and year to date is 11,400. And I'm using 2 contracts to place these trades, and it works really, really well. I'm going to share with you these trades here that were just recently placed. All right, so on July 27th, we placed a call spread and a bull spread. And so that's an iron condor. And we received 65 cents for the call spread, and we received 80 cents for the put spread. And then so the premium at that point was $1.45 that we received. Then what happened? July 28th, what happened was that we closed the trade because the market went up. And so we closed that trade and then placed the call spread again, and we received 65 cents. So now the premium is $1.20. All right, so July 31st, we opened a new trade, a put spread, and collected 70 cents. And so now we have trade 564 that was placed on 727, and the 566 trade was placed on 731. Okay, so now we have an iron condor here again, and the premium now is $1.90. So August 2nd, we had to close the trade. Now the market moved lower, and so the call spread was 5 cents, and then we rolled the put spread down, and so we went from 45.20 to 44.85, 44.70. What that did was that we widened the spread, okay, so that it would go down further, and we got 0 credit for that. But what happened was that we were de-risking the trade, so we reduced it further down. And then we placed another trade and collected 90 cents for this trade. So now, all in all, we have now 2 trades. It's an iron condor. We have 45.85, 45.70 with a 70 cent premium. And we have 46.45, 46.65 with a 90 cent premium. And so what I do on these trades, we widen them and place a new trade. I'll place the same margin for that trade in order to keep it symmetrical and widened sufficiently. And that actually gives you a better risk reward on the trade. So now we have a premium of 275. So now, August 3rd, the market moved. And so we were able to close this trade because the opposite side was being threatened. So we closed this trade first, and then we added a call spread to the position. And now we have the 2 positions here on another iron condor. If you look at the -1, that means that we rolled that position 1 time. And so now we have 44.85, 44.70, and then the call side, we have 46.10, 46.25, and we should receive that credit there of 80 cents. So now our premium is $3.35. So now you can see here this big dive down, okay? August 4th. So August 4th, the market went up, and then it went down very quickly. And so we had to adjust the trade. And so at this time, I saw that the trade was being threatened. So I said, okay, let's close this trade at 25 cents. So we got a profit on it. And then we opened a trade. We went from 45.85 to 44.70, and then we opened the trade for 46.60, 46.40, and basically it was a debit of 5 cents. And so my goal was to get the trade as furthest away from the money as possible so that we can manage it and still retain profitability. All right, so here now we have the 566 trade and the 574 trade, which is new, and we have another credit that we received. So now our premium is at $3.05. Now on August 9th. August 9th, again, the market went down. And so we closed the call spread for 15 cents. So we rolled the trade down, and we actually collected 10 cents on that trade. So we went from 40.60 on the short strike to 40.45 on the short strike that the trade was adjusted. So now we have, again, you can see here 3. So we've rolled this trade 3 times. And now we have another credit that we added, and now we have a $3 premium. So now, August 11th. August 11th, again, the market went down. So we closed this trade at 10 cents, and then we added an additional call spread for 75 cents. And now we have the 40, 45, 45, 20, and the 45, 35, 45, 55 call spread. Okay. And this is where the market is just continually going down. So now we have a premium of 365. So that's really where we're at this point. And actually, we had to roll the trade today because the market continued to go down. Okay. So that's really the process of managing these trades. And eventually what happens is the market, it doesn't go down forever, but we've gone down about 3%, but we eventually get out of those trades, and we do this over and over again. So this is really the process for how to maintain profitability when you have those trades. And it looks like today we may get a little rebound here so we can push and get out of these trades. And if not, we roll them again.